Good morning, Jags. This is Fahad. Today is Monday, February 8th. Let's get started. Just like to cover one stock today, a name that we covered previously in webinar, and I think it has a very nice setup over here for more upside to come. The stock is called RAVN Industries, symbol RAVN. Many Jag clients, the pro clients, would know that back in early December in webinar, I presented the bull case for this company. And we recommended buying February 30 call options at the time for $2.30. Excuse me. And the target was $34 per share. This company has previously served as a cyclical provider. It's a very highly cyclical business and has previously served as a plastic film sheets provider in the industrial, energy, construction, agricultural segments or whatnot. But in the past 2 years, this company has been reinventing itself materially by getting into autonomous carts and equipment for farmers. Basically, this is an ESG player with the autonomous driving and all that, but is specifically focused and realigned now with the business that is dedicated itself to the agricultural industry. A lot of interesting launches have taken place as a result in the past couple of months. And when I look across the entire spectrum of research note on the street, and there's not a lot of coverage on this one, but whatever is available, I get the sense that the stock is simply not being appreciated on the street as much as it should be, because the news has been out there, but doesn't really get talked about by any. And back then, when we recommended this call options, the stock was just starting to break out. It was a fantastic run for us. It went straight to exactly what we thought it would do. The price target was 34, and those February call options essentially doubled. And then it went to a consolidation phase, had another breakout, came back, retested, and I believe this fresh new leg higher with the MACD and the RSI levels having corrected already, I think is going to carry the stock all the way to mid 40s, and the stock currently closed at $35 per share. There's a couple things that you should know. Again, lack of a street research on this one, so I'm going directly to the source. There is this news came out. This was back on, I believe this was on December 2nd, right over here, that RAVN Industries has opened pre-orders for driverless ag technology. Basically, now people can drive these tractors in the farms without having anybody present, and you simply connect them by phone or through a mobile device through a very simple software, and you can control the entire program on vast fields of farming corn and whatnot, all driverless. And this was this was launched and this was originally announced in November, and the company started to take pre-orders for this technology in early December. So this thing has been out there now for a couple months now. And when I look at the forward earnings estimates on the street, they have not moved at all since this pre-order began. In fact, on a year-over-year basis, everybody is expecting this company to finish fiscal year 2021, we're talking this current year right now, everybody's expecting this company to post a 33% decline in earnings compared to 2020, and 2020 was hurt badly due to the pandemic. And so nobody is expecting any kind of major progress, but this company launched this major product in November, and they started to take pre-orders for this in December, and I think this is a potential catalyst to surprise to the upside. So there's that. And then the second news came out. This was on December 15, just 2 weeks after that, in which the company also announced new connectivity tool for ag operations. And this is called, the virtual thumb drive through RAVN CRX field computer seamlessly sync information between the office and the field. Once again, the company has become a forefront of technological changes that it's trying to bring to the ag industry to streamline operation, lower the cost, and automate the entire function. There's a lot of manual work that's still involved in the industry, and this company is quickly changing all of that. In a way, you can take a look at this company and say this is no longer an industrial. The way it continues to transform itself is becoming more and more like a SaaS, providing the operational tools necessary in the background, bringing hardware and software together to automate the agricultural industry. And so this was another one. Only 2 weeks after the first launch, they announced this connectivity tool. Once again, not built into the consensus view. Only one analyst has so far come out, and that was recently, I believe it was Oppenheimer, recently, in which they raised the price target on this stock to about $45 per share. I have to confirm and double check on that one, but that's the only news that I can think of. Yes, it was Oppenheimer. They raised the price target from $28 to $41 per share. That was on January 25th, and that's when the stock started to turn around. I think it's going to see more upside. I think it's going to go from 35 to 45, and this company will report earnings sometime on March 23rd. So lots of time until then, but I think we're going to see lots of positive surprises in that one, given these important product launches. That's it from me. Let's go to Jay.
Good morning, everyone. So my next homepage write-up, most likely later today, is going to be on the mattress industry, but more specifically, it's going to focus on Purple Innovation, ticker PRPL. I believe last week in the webinar during the Q&A session, we did have a question come up on the company, and we essentially just said, we'll take a look at recent comments, recent checks. So I was able to pull a handful of notes, and I will share those with everyone on the homepage. Looking at their earnings history, there's no confirmed date yet, but historically they do report in early March. So we do have a few weeks until that event. So yeah, just look out for a new homepage right up later today.
Fantastic. Looking forward to this. Is a stock. It's a former Jaguar top pick from the quarterly outlook, and it has always been of major interest by all clients. We've been covering this name since it was $9 per share more than a year ago, and now it's 38. Fabulous stock it has been. So looking forward to what you find out in terms of the specific channel checks on that in that note. And let's see if we can position going into earnings based on those checks. So I'm sure this is gonna catch plenty of eyeballs from Jack clients. All right, let's go to Chronicle.
Good morning. I have two trade ideas today, but before I get into them, I wanted to first mention that I think now is a good time to, at the very least, lighten up on Channel Advisor, ticker ECOM. This was a bullish idea that I first presented on December 9th, and then I reiterated the bull case on January 15th. And the stock is now up 50%, give or take, from when the idea was presented. If we recall, 50% upside was exactly my target. And with the company going to report this Thursday, I think it's prudent to step aside because consistent with what we've been seeing throughout this earnings season and judging by how much this stock already ran up going into earnings, I wouldn't be surprised if the company reports fantastic numbers and the upside is still capped from here. So I think there's going to be a high chance that we'll be able to re-enter at a better price.
Yeah, very good. And yet again, a very impressive run on this stock and a timely play. Once again, in the conversations on December 9th, right here, is when this bull case was presented on ECOM, right over here. And we specifically pointed out that this stock could see as much as 50% upside over the course of next 12 months. This was December 9th was right here. And you can see this stock has since rallied from 14 all the way to 23. So you were looking for 50% upside over 12 months. Well, here you go. You got 65% upside over 2 months. So can't complain about that. Fantastic stuff. And the next ones?
Sure. So for the first trade idea, I have some slides here. This is essentially a continuation of the advertising theme that has helped us make money from being long Channel Advisor. So basically, I'm going to exit Channel Advisor and rotate into a company called Clear Channel Outdoor, ticker CCO. So this company is a specialist in digital and animated outdoor advertising and displays across more than 20 countries globally, spanning North America, Europe, Asia, and even LATAM. They were originally a subsidiary of iHeartMedia, but then they separated in 2019. The main reason why I'm suggesting to be long this stock is because with vaccinations starting to pick up speed in various countries, I think right about now is when the year-over-year comparisons for physical outdoor advertising will start to get a lot easier relative to the comparisons for online advertising, if you get what I mean. Because all throughout last year, the pandemic pretty much decimated demand for outdoor advertising, and that's going to result in stupidly easy comparisons once we begin to reopen as this year progresses. As we're coming out of this recession, there's going to be a lot of new businesses springing up, as well as the survivors who will no doubt be coming up with a lot of new products and promotions. And all of these businesses are going to be in an intense fight for a slice of the reopening pie, so to speak. So as a result, I do foresee demand at an intense level for outdoor advertising as people globally begin to leave their houses. If we think about this, we could potentially see close to triple-digit year-over-year comparisons in Q2 in terms of outdoor ad revenue. Now, coming back to the companies, so up until last week, this was a financially troubled enterprise because it had over $5.5 billion in debt, partly due to its dividend obligations to iHeartMedia. So this is a very levered balance sheet, which is why the stock plummeted roughly 80% during the pandemic, because there was high risk of bankruptcy, especially given that $2 billion of that debt is currently priced at 9%. But then last Thursday, news emerged that the company has managed to refinance close to $1 billion of its debt, which is going to result in roughly $20 million of annual interest savings going forward. So all things considered, they now have $845 million of cash on their balance sheet, including $250 million from their recent divestiture of their Hong Kong partnership. So $845 million cash, and we're looking at $360 million of annual interest expense. So there's very little risk now of bankruptcy, at least in the near term, which is why the short interest ratio for this stock has come down from 30% to 9% over the past week. And as I always like to say, leverage works both ways. So as we're coming out of this recession, I have these graphs here for revenue and earnings, which show consensus is looking for over 70% year-over-year growth in revenue for Q2 of this year. On top of this, I would also add that eMarketer back in June last year put out its latest forecast on out-of-home advertising, which show that digital outdoor advertising spending is expected to continue growing. So contrary to this popular belief that physical outdoor advertising is a dying industry, this shows that it's actually still very much a growing industry. Just because online advertising is growing doesn't mean that outdoor advertising is not growing. So looking at my annotated technical chart on the next slide, this stock is currently trading at $2. And I think over the next couple months, it's going to attack the next VOP resistance level of 250. So I think there's 25% upside between now and Q2, and then we can always reassess after that. Regarding valuation, it's currently trading at 0.3 times sales.
Very interesting stuff. Clear Channel is something that we haven't covered in a long time. Rarely ever actually appears on discussions. I want to ask you something, and while the bull case here is presented based on the idea that we're going to see the reopening theme that will lead to higher advertising on the traditional outlets such as outdoors, essentially not digital as much, but the benefit of going out and you're going to see these advertisements, and I'm talking about, for example, billboards and all of this. How does this discussion tie into this another name called Outfront Media, OUT? Not sure if you've actually looked into that one. Jay has covered this name quite a bit in the past. Doesn't this directly apply the same exact bull case to this company as well? Just high level view.
It's similar company as well as Lamar Advertising, but I would say that this company, Clear Channel, has more exposure to digital billboards. That means like basically graphics that move and animate.
Okay. All right, sounds good. We'll keep an eye on both of these, Clear Channel as well as the Outfront Media, because I think the theme will potentially play out for the benefit of both of them. And then Lamar would be the third one, but that's more diversified and nationwide play. Outfront Media is more specific to the urban locations such as New York City, the bus stops and cabs and all of that as well. Moving on to the next one, which is SunCoke Energy. Interesting
Sure.
one.
So this is the second bullish trade idea is another speculative one. It's a company called SunCoke Energy, ticker SXC, produces both thermal and metallurgical coal or met coal, which are respectively used for producing electricity and steel making. Now, before I get on the bull case here, I just want to mention the short volume ratio in this stock is currently just under 30%. And I think the reasons why the market is heavily short this company are mostly to do with how the coal industry in general is in secular decline because of the ESG movement and the shift to renewables, as well as how difficult it can be for these companies to secure loans or liquidity to refinance their debt. So this kind of company tends to be an easy target for short sellers because it's one of those so-called lazy shorts where people are just putting it on in the view that it's a low maintenance trade because over the long term, the business is likely to be terminal due to bankruptcy risk or gradual demand decline, especially for electricity generation. But having said that, it needs to be stressed that one thing a lot of these short sellers fail to acknowledge is that when it comes to secular decline stories like with coal, these industries are not going to go down in a straight line. Because there's always going to be temporary bounces along the way because of interim cyclical tailwinds, which can often result in near-term alpha just because of how depressed the stock had been. And I think this company, SunCoke Energy, is an example of that. So my main bull case here is that the price of Atlantic met coal has shot up in recent weeks from $100 per ton to about $160 at present. Because on the next slide, as you can see, there's an ongoing rift between China and Australia, whereby China is currently restricting imports of coal from Australia because of their recent criticism of the Chinese government. So as a result, China is now turning to North American producers to plug the resulting gap amongst other producers. And even though America doesn't really like China, it's not as if these US coal players are going to turn away the Chinese demand. Now it's down to 450 tons in December. The Australian exports to China, it's now down to 450 tons in December from last year's peak of 9.64 million tons in June. So other countries, including the US, they're going to have to pick up the slack here. Now, coming back to SunCoke Energy, this is obviously a positive, unexpected tailwind, which should help their balance sheet and their cash flow for at least the near term. Currently, looking at the sales estimates, consensus is expecting a 37% year-over-year decline for this March quarter revenue, followed by a 5% increase in the June quarter. However, just like with RAVN Industries, it looks like the revision the last revision was done several months ago, back in November, because it's not a very closely followed company, and so I think this is now too conservative given the recent price surge in Atlantic met coal. So looking at my annotated chart on the next slide, I think we can get very high beta from this stock where it can get from $5.75, currently targeting the long-term resistance level of $7.75 between now and the next earnings report. And on that note, one last thing I'll mention is that the company already reported last week, so we don't have to worry about how this stock is going to react to earnings because that's already out of the way. In terms of guidance, management said in the conference call and presentation that they are likely to exceed their original guidance because of an anticipated strong recovery in not just domestic markets, but also they are saying that the forward curve in coal futures has been indicating a persistent increase in coal export volumes. So this is coming straight from the management's mouth. So putting everything together here, yes, this is an industry that's in secular decline. And I have my doubts about whether this company is going to be alive and kicking in, say, 20 years' time. But for now, I think there's enough of a cyclical tailwind for us to see some upside in the near term. And at the same time, there is quite elevated short interest. So this could squeeze if the market catches wind of the supply imbalance that's going on because of what China is doing to Australia.
Yeah, very interesting update over there. You know, the big message here on the coal sector is what you just stated, which is that we're not arguing here that there's no secular pressure on these coal stocks. There definitely is. There will be in 5 years, 10 years, 15, 20 years from now. The same, by the way, can be said about the energy sector in general, the oil producers as well. But a lot of people completely ignore, based on that high level view of secular pressure, they ignore the powerful forces that come into play with cyclical upturns and downturns, during which some of these stocks can have significant amount of move. You know, I mean, the same thing applies to the oil as a sector. Basically, when we turn so bullish on XOP, the US shale gas producers, many people will find this extremely hard to believe that the US Shale Gas Producers Index, or ETF, XOP, is up more than 70% in past 4 months. More than 70%. This ETF. There is no other sector that comes anywhere close to matching performance of the energy sector like this. But people continue to question, yeah, but what about the secular pressure and the ESG theme and the electric cars and all of this? But that's what confounds their judgment about a major positive cyclical tailwind that is coming in the favor of these companies. And the same thing is applied to the coal sector. Going back to SXC, you know, last week when I was looking at some of the metals and mining stocks, and I mentioned in one of my write-ups in the trade ideas that was issued that coal prices have jumped by more than 50% in just 15 days because of this rift between China and Australia, and China is now looking to the United States to buy coal. I was also looking actually at SXC, but at the same time, Warrior Met Coal, HCC, which was also on my watch list, and the biggest of all, Arch Resources, ARCH. I mean, these are the names that we have been bearish on in the past, but for the precise secular reasons. But cyclical tailwinds and benefits to these companies cannot be ignored. So I think the same bull case that you have laid out over here for this high beta named SXC can also be applied to some of those other coal stocks. Looking back at my own technical views on this one, yeah, take a look at this, how after a 3-year of downturn, SXCs are starting to move out of this. I think it can possibly go all the way to $8 or $9 per share. It's at $5.70 right now. So we'll see. All right, folks, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.